Good afternoon, everyone.
Hey everyone, Carter Malloy and Maddox here. We're excited to visit with you today and talk about some of our favorite macro themes and investing topics. We're trying out a brief webinar format, so we'd love to hear your feedback on this. We're going to try to fly through and condense quite a bit of information into a short period of time. We can expect it over time. For some quick background on me, this is Carter speaking. So started the company AcreTrader, started working on it over 5 years ago, and we launched almost 5 years ago at this point. Uh, Prior to that, I spent about a dozen years in equity investing. So was working both on the sell side and the buy side. Most recently as part of a founding team of a long short investment fund or hedge fund. Spent basically a dozen years looking for information asymmetry around markets. Uh, what was fascinating to me is the background. I had spent my time, spending lots of time rather, investing in farmland, investing in land. I grew up in a farming family. I was just absolutely obsessed with it. And I was having interesting and promising financial returns, although the actual active investing was very difficult. And thus really the idea for AcreTrader came about. My dad, now with 150 or so people that I get to work with every day here, but ultimately with a simple goal of making buying and selling land common, transparent, and easy.
Yes, and I'm Ben Maddox, the Director of Farm Operations here at AcreTrader. I've been with the company for a number of years. My role is really leading our team that focuses on identifying and researching the different properties you see on the AcreTrader platform, whether it be timber properties or farmland properties. I've got a accredited farm manager's license from the American Society of Farm Managers Appraisers, as well as a broker's license. I'll be joining you in the second half of today's presentation. You may have noticed our video camera went off. We'll be turning that back on during the question and answer session, where you'll get a chance to kind of respond to some of the ideas we're presenting here today.
All right, great. So this is Carter speaking again. The conversation here begins with a look at inflation in the U.S. over the last 7 years. Observing these year-over-year changes in interest rates and inflation, we can see evidence of clear trends of rising interest rates and accelerating inflation pre-1980, and falling interest rates and low inflation post that period. The post-'80s falling rate environment has been good for financial assets. The key question is now facing us as investors, all of us here, is whether or not the falling interest rate and low inflationary environment of the last 40 years will return, or are we in a new investment landscape? This is what we refer to as a regime change, meaning really the steadily falling interest rates and low inflation may not be the driver to financial assets that they once were for many of our, or for much of our lifetimes here, what we call. The period, as you see here on the chart, in the red on the left, pre-1980 was dominated by rising rates and rising inflation. Inflation in that period was not really tamed until Paul Volcker pushed the Fed funds rates to around 20%, that inducing a couple of quick recessions. In the 40 years since then, we've been in an environment of really decelerating inflation, marked by lower and lower interest rates. The data we have now is suggesting this new regime again of higher inflation may be returning, but the CPI, Consumer Price Index, measuring 8.2% through September this year. That rate is the highest annual increase we've seen since the 1980s. This is important. So while consensus expectations are for inflation to be tamed somewhat by 2024, consensus has been very wrong over the last year. So we thought this quote was interesting coming out of Bank of America. Here, what we're looking at is some research from BlackRock that examines past performance of real assets during macroeconomic periods dating back over the last 20 or so years. BlackRock had included farmland for their analysis, so we added that in here for comparison on the left. Well, we'll leave it up to you to decide what future scenarios you feel are most likely. It's clear that real assets have historically outperformed financial assets in high inflation environments. So one of the critical factors to keep in mind, what we'll tap on here, is the impact of higher inflation is that it erodes purchasing power, and therefore it erodes returns. So this chart shows the annual total return for the S&P adjusted for inflation going back to 1960. So basically showing what your gains were, then making those real by pulling inflation out of it. And the key point here is that when inflation rises above 5%, we've chosen that here for illustrative purposes, in the shaded areas, the S&P total return was down a couple of points on average. And to be clear, we're not here arguing against equities in a portfolio. Only that real assets such as farmland and timberland can serve as a key tool in investors' portfolio to provide diversification and potential protection against impacts of inflation. So diversification is said to be the only free lunch, really, but it's critical to remember that you only get diversification when things in your portfolio are negatively correlated, meaning when one goes up, the other tends to go down. So they help to offset each other and or hedge each other out, say, in certain times. So research recently has begun to really challenge this idea of what's become pretty common, the 60-40 portfolio that we're all accustomed to. And this chart explores that idea further. Over the last 20 years, stocks and bonds have been negatively correlated, and thus they can hedge each other out sometimes. But historically, returns to stocks and bonds prior to this, since 2000 or so, have had positive correlation. I think that surprises many of us familiar with the 60-40 portfolio construction and raises some important questions about the role of alternative investments in a portfolio. So if we take the long view here, we see the stocks and bonds on average, again, positively correlated, which is shown by that purple band, the purple average there historically. And that trend is beginning to present itself again, once again, in today's market, thus again, calling into question these things providing us some protection. And we see that this year. So we're zooming in here. You've been following the markets, I'm sure. It's been a difficult year for stocks and for bonds both. Returns for major indices are deeply negative, and once again appear to be moving somewhat in tandem, as suggested by that past historical relationship. So we included farmland on this for a couple of reasons. One, we talk a lot about farmland's role as a non-correlated asset class. It's historically had very low correlation, if any at all, to the S&P, and we see that again, yet again here today. Two, importantly, is the returns here in green are not atypical to farmland. This is an important note. Research shows farmland has had consistent returns over time, even during times of economic turmoil. So the stability of the returns can be highly attractive. Looking at the S&P down 24% here as an example, we can't recall a year where farmland was up 24%, nor down 24%, or anything close. And that's what's really important to note is it just tends to compound steadily over time. It tends to be a fairly boring asset, which obviously is important, as we said here today. So we always certainly stress that information is not investment advice on this slide in particular. It is worth considering, however, the inclusion of farmland and timberland and how that would impact a theoretical portfolio. So this is data being over a 25-year period. The most recent we have it updated. And we can see that including farmland in the portfolio would have improved returns and reduced volatility compared to a portfolio without farmland. Ultimately, choosing the right blend of investments within a portfolio is a conversation between you and your investment advisor. And these asset allocations are only meant to be hypothetical. But additional research by Newton and Sense has also come out saying that allocating as little as 2 to 5% of a portfolio to farmland and timberland can improve a portfolio's overall returns and at the same time reduce risk.
Thanks, Carter. I'm going to join you and speak a little bit more to the specific parts of farmland as it relates to inflation, which most of the time we're going to refer to as the consumer price index here throughout our slides. So during inflationary periods, investors have looked towards real assets, including farmland, to serve as a hedge in their portfolio. And why might that be? The data on this chart goes back to 1969. What it shows us is that farmland has a strong positive correlation with the CPI, which, as I mentioned, is a standard measure of inflation in the US. When measured against other investments over the same period, which you see in the top right-hand corner there, farmland has outperformed gold, equities, and bonds as an inflation hedge. But it's not just positive correlation. Farmland has served as a store of value in inflationary periods, keeping up with and often beating inflation. And that's what we see on this slide. When we talk about fighting inflation, which is actually the title of today's webinar, we can look at correlation as we done on the last slide. But perhaps more importantly, we can also look at the spread of total farmland returns over the CPI. So farmland has a long track record of outperforming inflation, and a decadal analysis reveals a positive spread in every decade going back to 1970. Put simply, farmland has been consistent in beating inflation. Astute observers looking at this chart might also ask about the negative returns in the 1980s. We'd be remiss if we didn't address that on this slide. That's what was known as the farm crisis of the 80s. And while that was a short period of negative farmland returns, we would argue, and a lot of research points to, that was a pretty different setup than we're seeing today. Primarily, there were several factors in the 80s farmland crisis driven by both over leverage in the farmland sector, as well as a high federal funds rate, which Carter alluded to earlier today in the presentation. Today, we see both healthy farm balance sheets and a Fed funds rate around 3.25% instead of 20%. So staying on that topic just a little bit longer, we do want to call out that higher interest rates linked to inflation can be a negative. That's because it could remove some buyers from the market that would typically use a mortgage to purchase farmland. With that being said, debt ratios, as you see here on the screen, are meaningfully lower than they have been in past history, especially during that 1980s period. This also compares in stark contrast to residential and commercial, where debt ratios are very meaningfully higher. It's worth calling out, in the state of Iowa, which is traditionally a major farmland state, 82% of Iowa farmland is fully paid for. So I think while that's an anecdote and sort of one point in time, it does speak to this larger body of farmland leverage and what this chart is showing here on the screen. This chart from MetLife does explore potential scenarios for farmland values in different inflationary environments. There are, of course, scenarios below these in which farmland may perform worse. We don't mean to indicate it will only perform like this, but the forecast is instructive nonetheless. Inflation does have an impact on farmland values. It's important to understand why that relationship might exist. Put simply, there's a supply and a demand element to this relationship. On the supply side, farmland is a finite resource that resists devaluation because they aren't making any more of it as we lose acres every year to development. Further, it's a real asset that appreciates, but also produces income with the ability to reprice rents over time. And then on the demand side, of course, there is a direct relationship between farm commodities and consumer prices. Farms produce food, fuel, and fiber, which are all major components of the CPI. We wanted to consider just a few alternative investments to farmland that are traditionally seen as inflation hedges while we're discussing the topic. Historically, gold has been considered an inflation hedge, but is that reputation warranted? We see that while farmland has held up against the CPI year to date, gold is actually down 8.6%. Similarly, other common investments, 10-year treasuries and tips, are also down 13% and 15% respectively year to date. We see why that might be so as we move towards this slide, sort of highlighting the concept of negative real interest rates. So in real terms, 3% money markets or 3% yield on your funds currently starts investors out in a hole over 5% when accounting for and adjusting for the inflation impact. And that's something that, while it's a rudimentary concept, we can't overstate enough. We've certainly heard a number of investors saying that their money markets or Robinhood accounts are paying 3% on invested cash. And we want to call that out loudly as a dangerous concept in a high inflation environment.
All right, so this is Carter here, trying to wrap us up in our 15-minute timeline. So while most of the analyses today have focused on measuring farmland returns through USDA or macro data, we can also display some actual returns to previously exited AcreTrader investments. Diversification across asset types, geography, and crop type is important for the individual investor. And these exits represent 4 different states and different regions growing different crops. To be clear, these are past performances. These are not indicative of future results. Specifically, a 30% annualized return on the bottom right here is not normal. We were jumping up and down about that. But that's part of the appeal of farmland. Is you don't often hear about people doubling their money overnight, but you also don't often hear people taking steep losses. To reiterate a core fundamental here, these returns are comprised of both annual cash returns and improvement in value. In the situations we're showing here, the cash income is nice to have, but really the upside came from value appreciation during inflationary times. And we view it as farmland has a decent coupon, right? It compares to money markets. It's maybe not something to get overly excited about, but the exposure to the underlying asset and potential appreciation is what most investors buy farmland for. Our large team here focuses on an intense due diligence process, backed up by lots of the software engineers and data scientists. And we're not really trying to identify farm and timberland investments for the AcreTrader platform every day. So investors can easily diversify with low minimums. So with that, made our 15-minute cutoff. We'll hang out for a few minutes for questions. You're certainly also welcome to reach out directly to us after this. For those of you that booked 15 minutes, you're welcome to hop off and join the replay later if you'd like as well. We thank you.
You'll have to give us one moment to pull up the question list here.
One of those is what's the minimum investment? That's usually around $10,000 to $20,000 in this. It depends on the offering and the size of the offering, and a few other considerations as well. There's another one here about wallets bearing interest there. I think, yeah, again, we're not big fans of holding cash anywhere for that matter today in this environment. We are working on that for early next year. Though again, we're not particularly excited about that. We are excited about Farmland.
There's a couple questions about recording, so there will be a recording available of this. So if you have any questions about slides, we'll get to those. You'll be able to see them on the recording. A couple questions here about shortages of fertilizer, fuel, and other commodities impacting farmland. So I think certainly it's been one of the biggest headline stories for farmers over the last year or so has been the rising prices of fertilizer and fuel, particularly diesel, of course. And, there's no doubt that those are compressing margins for farmers on a per acre basis. Now, we certainly climbed down from the highs of fertilizer prices we saw really in the springtime. So we're a bit below where we were previously. And, some research, particularly at land grant universities like University of Illinois, are still projecting positive gross margin income on a per acre basis for row crop farmers in their region. So that'd be for 2023. So we're still seeing positive returns on a per acre basis, despite high input prices. It's definitely a trend to watch. It could have an impact in the long run. But right now, for the most part, the high commodity prices are offsetting the input prices that you can see in the news.
How many farms do you have to invest in currently? So we've invested in 35,000 acres of farmland across the platform. So well over 100 farms. We usually have one or two farms on the website at a time. Farmland total return in the last 20 years, some there as well. From shooting from the top, it's been around 11 or 12%. And that's fairly consistent over multi-decade periods.
Sorry, we have a lot of questions coming in, so we're working on it.
We also got to adhere to our schedule here. Have a couple more minutes, and then we'll also be reaching out directly to you.
There's a question here. Do you think farm rents will go up in 2023? It's a really good question. I think most estimates, again, coming back to research done by the land grant universities, and I'm going to speak primarily about the heartland, so Iowa, Illinois, Minnesota, those states. Most of those research universities are projecting slight increases in farmland rents for the year in 2023. So yes, we're still seeing rises in farmland rents.
Okay, and a couple of questions around diversification by geography, crop type, through the question list here. And the answer is we see folks doing both, certainly. As a reminder, throughout the U.S., about 60% of you'll know this better than I do, about 60% of planted acres are corn and soybeans. So we do view those as pretty core to the thesis.
Question here about what are the risks do you have in securing a lease for land that you might be managing? So it's actually a really interesting question. One of the elements that attracted both of us to investing in farmland is the concept of very little to zero vacancy in farmland. So as long as you're investing in an area that we would typically live in core farmland regions, and you can read more about that in our learning center. But if you're investing in some of these core farmland regions, there's quite a bit of demand for lease, ground for lease, right? So on the AcreTrader platform of the 100 some odd investments that we've hosted to date, we've never had a vacancy on the property that we've managed. And so I think our experience at our company is definitely extrapolated to the larger farm leasing economy. We see very low vacancy within the farmland sector.
And lastly, being asked here, fees and commissions for us. So often that's paid by the seller. So we participate in real estate transactions most regularly, and that is something that's inside of the deal regardless. So we view that as it's a good way for our business to earn income on fees that are typically paid anyway. And then we do charge a 0.75% management as a percent of asset value. You will find that is very, very low relative to industry fund standards that tend to be materially higher. We live here in Arkansas on the land of Walmart, and we are big believers in everyday low prices. So no, we're over on time here for sure. So we'll make sure to try to reach out to folks directly as well. So we'll make sure you guys know we got a ton of questions here, and I'll make sure I try to get to you today tomorrow.
See, there's a question here. I see that the row crop annual returns are in the low single digit cash yields. Is there any possibility that those might go up as commodity prices increase? So I'll answer the question in two ways. The first way that I would answer that is yes, there is a possibility to obtain higher rent over time as commodity prices increase, either through repricing a rent as the contract actually expires, or through something called a flexible rent, which is one in which the landowner and the farmer share in the upside and sometimes the downside of what commodity prices, crop prices are doing in that given year. Now, the second way that I would answer that question is really coming back to the concept that farmland has two sources of return for investors. There's the annual yield, that cash yield of the investment, as well as the capital appreciation, which of course is realized on the resale of the property. It's really that capital appreciation that it historically has overperformed in these inflationary environments. And that's kind of one of the reasons we wanted to draw people's attention to this topic with this webinar is that if you take farmland simply as a fixed income alternative, you might wonder, what the value proposition of farmland would be for a portfolio, but it's really that inflation hedging element of it that is of interest to us and what we're sharing here today.
So the 5 or 10 year term, can you withdraw before a 5 or 10 year term? So there's certainly first there's a mandatory 1 year commitment or lockup by investors on the platform for regulatory concern. Then after that, you certainly are able to, and you can, we're happy to facilitate selling that to, if you need liquidity, friends or family or through another platform. We have also built the technology on our side for a secondary market and are awaiting some necessary regulatory approvals on that front. So we're highly anxious and excited to have that out there. But again, we would certainly suggest that, as we've shown today, farmland we view as a long-term investment and would hope that you view it with the same lens.
There's a question here. What is your philosophy as to the role or importance of promoting progress and sustainability efforts on the farm? Love to get this question, so I'll answer in two ways. The first, most basic way is we're working on enrolling all of the properties that we manage in a program called Leading Harvest. And so you can look up the Leading Harvest standards online. We actually had the Leading Harvest team here in town to speak at our investing summit about 2 or 3 weeks ago. So we're pretty committed and involved in that program. That's the first part of my answer. The second part is we do have quite a few properties that are actually enrolled in the USDA Certified Organic Program, which is a separate program. It's a different standard, but we've had quite a few certified organic offerings on the platform over the years and are happy to call any organic farmers our partners.
It's there. And payments quarterly in the future is another good question here. We are looking to improve our payment schedules in the future. Quite frankly, it's an administrative burden. It's quite a big page that do all of the back office work for that. And again, we like everyday low prices, so we try to keep things pretty simple for folks. Though again, as our business scales across thousands of investors now, we're continuously building more and more systems with our engineers to ease that in the future and hopefully move towards a more regular payment schedule. I think I can happily say though, within that payment schedule, we have been can speak to Flexus in a moment. We've been very pleased that the large majority of the payments we have made to investors on our platform have been at or above schedule. Yes.
So very quickly on flex leases, again, it's this concept where you might have a floor, which is a cash lease amount between the landowner and farmer. And then there's this bonus rent that's paid. And that bonus rent is typically derived from both actual yield on the farm in a given year, as well as the market your average price over anywhere from 3 to 5 measurement points throughout the year to get essentially what the average price of corn or soybeans or some other crop might have been during that year. And you derive a bonus if the gross revenue per acre exceeds a certain threshold predetermined by farmer and landlord. So it's basically taking a fixed amount cash floor, adding on potential for a bonus if crop prices or crop yields exceed certain thresholds.
That also dovetails into another question we've gotten around what if the rent is too high and the farmer cannot make their payments? How do we react to that? I think say, again, there we've across lots of leases across many years, not have those issues. Right? We tend to do diligence on the farming partners we work with. We tend to be very proud of farming partners that are on the farms that we're working with as well. And often that rent is paid upfront. So in the example that Ben just laid out, the flex lease, right? The front end payment is March, so the farmers got all the things in order for that year, and then they get paid the potential bonus payments or share in basically the upside to the investors in the back part.
There was a question here about should I diversify by crop or by geography? So again, I'll preface this by saying I cannot provide you investment advice. There is a lot of great research both on our website, the Learning Center, and in some of the slides. So if you look at the reference material, which you'll see when we send out the recording, you can find that original source content. The only comment I would be able to make about that is, you really need to take a look at how is land used in the United States with respect to agriculture. So Carter mentioned this idea that corn and soybeans are planted on 60 to 65% of the total cropland acres in the U.S. And I think that's reflective of what sort of uh, beta would be for a farmland portfolio, right? So you need to look at, am I overexposed to what would otherwise be a niche crop like, well, I'm not going to call any out, right? Be kind to every crop, but you don't want to be overexposed to what's a fairly small crop produced in the United States. And so my only advice that I can really give you is take a look at how land is used in the United States and look at a portfolio that might reflect that land use.
So there appears to be a correction underway in residential real estate. What is the risk that farmland may be peaking or at risk of decreasing? And then also, what do we look at in due diligence to guard against overpaying? So uh, one is there a risk that farmland prices could go down? The answer is absolutely. Right, there always is. Uh, the where we find some comfort, and we shared this earlier as an example, is uh, uh, leverage ratios in farmland are like in the low teens, right, like 14%. Compare that with most new mortgages are 80%. So there's just an intense, potentially greater amount of leverage inside the residential real estate world relative to our world. So it's important to note there. But again, there are certainly risks as there are with all investments. Then specific to us and how we risk not overpaying, one of those is because we approach the market alongside farmers. So most of what we do are farms brought to us by farming partners. So that's where we start to look is with local farming partners about helping us to source land. Then beyond that is we have on our side what I would consider the absolute best database of comparable sales for rural land that exists in the United States. That is backed up by a team of about 35 or 40 software engineers and data scientists that have built our geospatial analytics platform that allow Ben and his team to go out and really evaluate farm at scale and quickly.
Last answer this last question probably unless Carter picks one out. So who provides liability insurance? What's the worst case scenario if someone gets injured? Good question. So you'll see actually in the farm financials for each property a line item for general liability policy. So each entity carries a general liability policy, and then we ask the farmer working on the property to carry a general liability policy as well as the farm manager to have their own general liability insurance policy, which we're listed on each of those. So we do try to insulate the sort of the LPs in each investment from those sorts of catastrophic on-farm accidents.
So what worst case scenario? AcreTrader dies, will you lose your capital? That's a totally fair question. One is for some context, we've raised about $80 million to get your capital for our business and have the majority in that too. So we are fairly conservative in how we operate our company and do not foresee that being the case. With that being said, in the operating documents alongside each farm, there is standard language in there to make sure that each of these special purpose vehicles are bankruptcy removed, so that they will continue to go on in a catastrophic event where Ben and I and everyone else here gets hit by a bus.
On that note, we will leave you today.
Very popular.
We will be providing reporting of this. So if you have any questions or we did not answer your question, we will get back to you by the end of today. We are at time. So I want to thank you all for joining us and hope you join us again in the future.
There are a number, to reiterate again, there are a number of you with consistent, lots of questions on here. We will definitely follow up with you. So we really appreciate your engagement, and we'll speak to you soon.
Thank you.
Thank you.